welcome to Looking at the Markets with David Modell. Today we have a very special guest. He is Mr. Andy Hecht. Mr. Hecht is a sought-after commodity and futures trader, an options expert and analyst. He spent nearly 35 years on Wall Street, including 2 decades on the trading desk of Philip Brothers, which became Salomon Brothers and ultimately part of Citigroup. Andy's bi-weekly radio show, The Commodities Hour with Andy Hecht, can be heard on Tuesdays and Thursdays from 5 to 6 o'clock p.m. Eastern Time on www.tfnn.com. Andy's first book, How to Make Money with Commodities, has received excellent reviews. Andy writes prolifically for SeekingAlpha.com and publishes a weekly newsletter through Marketplace on Seeking Alpha. Furthermore, Mr. Hecht teaches at the University of Colorado Denver Business School in their Foundations of Commodities course and blogs on his own site, dynamiccommodities.com. Whew, that's a mouthful. Thank you, Mr. Hecht, for joining me today, sir.
My pleasure.
Okay.
Great to be here, David.
Yeah, and I'm going to take a breath after that one. Not enough minutes in the day to do all that you need to do is what it sounds like. Well,
yeah,
I'm really
that's always
glad
the
to
case.
have you here. Yeah, what a history you've had. 35 years on Wall Street. Before we get into the charts, how did you even get started on your journey to finance and financial education?
It's really funny, a story. I grew up in Brooklyn, New York, and a friend's father worked for Philip Brothers, which at the time was the leading commodity merchant in the world. And at 16 years old, he offered me a summer job in the mailroom. I started in the mailroom. I worked there through high school, through college, through a little graduate school. Got a job when I graduated instead of going to law school in the traffic department, transporting commodities around the world. From there, I worked in traffic in various commodities. I got a job with the first options trading desk for commodities. That's where I kind of got my first trading job. And from there, I learned a lot about. I was lucky enough to work in this options department because I was able to learn about all of the commodities that the firm traded. People are generally in the commodities business very specialized. They're either an energy expert or a precious metals expert or a copper expert. They tend to concentrate on one sector or one specific commodity. But because of the options background I had, I was exposed to all of them. So it was kind of a lucky break for me. Then I wound up running the precious metals business, the nickel business, the sugar trading business for the firm, and worked for a couple of other firms, a couple of hedge funds, and so on and so forth over the years. And now I write about my experiences, and I write about what I think of the markets and try to analyze them, taking into account my historical perspective on the markets.
Fantastic. Now, I see we have a chart up already. I'm so glad you can share your charts with us today. Looks like gold. I've got gold, at least according to MarketWatch, is up to $13.23 per ounce. What is your outlook on gold?
I'm glad we're starting with gold. Gold is an interesting commodity, if you can call it that. Gold is a hybrid. It's kind of half metal, half foreign currency, half sentiment index. And, gold tends to do well in environments where fear and uncertainty rise. And we've seen gold doing very well. Also, gold is, like many commodities, is priced, the benchmark pricing mechanism for gold is the U.S. dollar. So as the U.S. dollar falls, gold tends to strengthen. And now the dollar is falling. I'll just switch to a chart of the dollar quickly.
Sure.
I'll put up a weekly chart. And as you can see, the dollar hit a high of over almost 104 back in January. But it has slipped about 12%, and we are coming close to very key support here in the dollar index at 91.88. We're trading at 92.175. This is critical support for the bull market that started way back here in 2014. If we break through there, that's going to be bullish not only for gold, but for many different commodities. But gold is reacting these days to a lot of things. Gold is reacting to fear and uncertainty about, the new administration in Washington. It's reacting to the dollar. It's reacting to North Korea. It's reacting to inflationary pressures on the economy from so many years of liquidity put in by the Federal Reserve and the ECB. And what we're seeing actually today on August 28th, gold broke to the upside. We're now trading at the highest level of 2017. The next level of resistance, we broke through 1300, which was resistance. Next level of resistance is up at 1377.50, which was the 2016 highs. And if I go to a little bit longer chart, you'll see that if we can get above there, then it looks like 1428 will be the next level of resistance. And above there, it could be off to the races. But David, the most interesting thing about gold here that I think you can watch for the next month or so is that I have a quarterly chart up here. What we see here is an interesting pattern developing in the gold market. We made a lower low in this quarter, the third quarter, than the second quarter. We're now trading above the second quarter highs. If we can close on September 30th at a price above $12.95.20 an ounce, which is now over $20 below the current price, gold will put in a bullish key reversal trading pattern on the quarterly chart. And the last time we saw this was back in 1999, before the big bull market began. So we could be coming into a zone here where gold could actually outperform a lot of other commodities and assets. You know, one of the things that I've really liked about the gold market, and I think has been a harbinger for gold's future, has been the rise in Bitcoin and Ethereum and these digital currencies. Gold, as I said in the beginning, is in a way, it's the oldest currency in the world, the oldest means of exchange. And I do think that given the current world situation, a lot of people might go back to buying gold here in this current environment, as fear and uncertainty are certainly on most people's minds these days. So I do like the gold market here. I never recommend buying any commodity on a rally. I like buying pullbacks, but right now, you know, gold looks like it's a one-way street. The other commodity that I think you got to follow here is silver. I think silver is really ready to take off for the moon. If gold continues higher, it won't be long before silver goes up. And silver is much more volatile than gold. Trades at a much higher historical volatility. It could really explode. The key levels to watch on silver: 1792 on the December contract, and then up at around 1888 that's the April 17th highs. Above there, we could get above 20 very quickly.
Yeah. And we looked at the dollar briefly. The dollar has been getting hammered in 2017 so far. You know, the contrarian part of me, the value investor, wants to get in. Is this a value play or value trap? What do you think?
Well, let me before I make a comment on the dollar, let me just say I am not technicals get me in and out of positions. It's fundamentals that really guide my thinking process on the path of least resistance for an asset price. So the fundamentals for the dollar have been very good, but the price has been falling. And I have a theory behind why the price of the dollar relative to other currencies has been falling. If we go back to when the dollar bull market started in May 2014, the dollar traded down to around 70, just under 79 on the dollar index in May 2014, and 10 months later, it was at 100.60. So it rallied 27% in 10 months. Then it entered a consolidation pattern for 20 months and rose to a new high after Trump was elected president. Now, it's very interesting. The bull market in the dollar started in May 2014, as you might remember, when the Federal Reserve announced that they were going to taper quantitative easing and they would start raising interest rates. And it was the perception of higher rates versus other currencies, you know, the euro, the yen, both, you know, short-term rates there, negative 40 basis points, and also involved in QE. But the dollar rallied because it was coming out of QE. Now, you have the same situation going on today as you had in the dollar, in the euro, where that currency looks like it is going to start tapering the QE, and you have seen the euro blast off from 103 up to 120. And I think that that's, what we're seeing in the euro. And if the euro has a similar move as the dollar did, it'll take it to 131. So I do think that the dollar is going to break down below that 91.88. And the reason is because the euro is going to be very strong. The French election supported the euro because it was pro-EU and pro-euro currency. The German election is likely to do the same, and tapering of the QE program over there in Europe is likely to support the euro going into late 2017, early 18, and that is bearish for the dollar, bullish for commodities.
Yeah. Everything you're saying now is chronicled almost word for word on your Seeking Alpha article, which just came out today. The moment of truth for the U.S. dollar, and everybody.
It's fresh. It's fresh in my mind.
Yeah, and as it should be, and everybody should know that if you want to learn more from Mr. Hecht, you should go to dynamiccommodities.com, which has easy to find links to many of his articles, which are, or just go to Seeking Alpha and search for him, and you can find many really informative articles on there. Again, that's dynamiccommodities.com. Check that link in the description. All right, so we covered the dollar, we covered some precious metals. Now, I know you're a commodities expert. I wanted to talk maybe about some of the soft commodities or even some grains.
Sure. You tell me what. Let's start with grains, then we can go into the soft.
Sure.
One of the things I start with like I said before, I'm a fundamentalist, so I start with a basic tenet. When I was born in 1959, not to give away my age or anything like that. There were less than 3 billion people on planet Earth. Today, there's more than 7.4 billion people. I mean, so population has more than doubled in the last 58, almost 60 years. So the bottom line here is that when population doubles, it puts a strain on the demand side of the equation, the fundamental equation for a lot of commodities, and no more so than in the foods. People have to eat. So you have two dynamics here. First of all, you have more people chasing food. Land is finite in terms of growing food, arable land. Second of all, you have a country like China, almost 1.4 billion people, and that country has gotten richer. And as it's gotten richer, it's moved away from a rice-based diet to a more complex grain-based diet. And they're eating more meats there. And as you eat more meats, the demand for soy meal and other feeds and other grains increase. So we've seen the base prices for grains move up. However, we've also seen a big bear market in grains since 2012, when there was a drought that caused the price of corn and soybeans to rise to all-time highs. I think soybeans were almost $18 a bushel, corn $8.50, $8.60 a bushel. Wheat in 2008 got up to $13 a bushel, but now we're back down. Wheat's $4, corn is $3.50, soybeans are $9.40 a bushel, but way down from those highs. What I like to do in these grains is when they're extending on the downside, first of all, I'm only trading them from long because of my fundamental view. When they're in the middle of the ranges, I'm not touching them. But when they're extending to the downside, like we're seeing now, I tend to be a scale-down buyer in all of the major grains, leaving plenty of room to add on price weakness. And then when we see the rallies, like we saw in late June and early July, on a scare in the Dakotas and in Montana over the wheat crop, and everything followed, you know what? I take profits during those times when other people are trying to pile in. Sure. I do trade contrarian in the grains. There will come a time, David, when these grains explode higher because the world has become very accustomed to bumper crops every year. This is going to be the 5th year in a row of a bumper harvest. So we're very comfortable. Consumers are very comfortable. They're not hedging. They're going hand to mouth. That's a mistake in the long term because the minute that these crops come in under bumper level, and it's not going to happen this year, might happen next year or the year after, we're going to see all-time highs in these grains.
That's a powerful statement. Like I'm looking at corn, CORN, which is an ETF, the Tucrium Corn Fund, just year after year since 2012, down. It's got some bumps in there, but man, that's
Absolutely.
scary.
Absolutely. Really ugly. But let's put a chart up here. Let's put a quarterly chart of corn up here. And let's kind of prove out my thesis about population growth. We're going to go all the way back to 1972 here. And you can see that the base price of corn has really increased. You know, we say now that 335 is a very low price for corn. But if you go back to the 70s, that was a very high price. And even in the 80s, we barely got above $4. It wasn't until 1996 that we got above $5, and it wasn't until 2008 that we got above $7 in corn. So the base price is coming up for these commodities, and you'd see the same thing in corn. You see the same thing in the soybeans. If I put up a longer term chart, you'll see the same thing in the wheat. If I put up a longer term chart, the base prices are increasing here, but we are seeing a sell-off here because 2017, another bumper year for production.
Yeah, which cannot continue indefinitely. So
exactly,
it's got to give at some point. Fantastic. And the softs, how do we feel about those right now?
All right, so let's go through those quickly. Sugar had a great big rally. Let's put up a weekly chart here so we can see that. In August 2015, sugar was trading at just over 10 cents a pound. The price doubled until 2016, and of course, like any commodity, production increases at the top, inventories start to build, demand goes down, and the price falls. So we've fallen back down to here to 12.53 cents per pound, where support now lies. We're at 14.3 cents. I'd say sugar is really in nowhere land for me. There's nothing compelling about the sugar market right here. I do like it below 12 cents. Right here at 14 cents, I wouldn't go short. I wouldn't go long. Coffee, on the other hand, I think coffee is more interesting here. Coffee has been making higher lows over recent years, and I think down below $1.30, it's a scale-down buying opportunity in the coffee market, but make sure you take profits when the price goes up. It's a medium-term way of looking at it. In terms of cocoa, cocoa got absolutely crushed. It was the one commodity that bucked the trend during the bear market for commodities. It has fallen from $3,400 a ton down to $2,000 a ton. It was traded as low as $17.56 this year. Right now, big supplies out of West Africa, out of the Ivory Coast and Ghana. They weigh on the market. The weak pound, because London is the hub of cocoa trading, that also weighs on the price of cocoa. And grindings, which means demand, is not that high. Again, in cocoa, short term, I'd be a scale down buy, a scale up seller. I think it needs to consolidate in a range between $1,800 and $2,200 per ton. Cotton, I like here. Cottons are a very illiquid commodity at times. This thing went up to $2.27 a pound. Let me put up a longer term chart. Back in 2011, and then a couple of years later, it was down to under 56 cents a pound. Right now, we're trading at around 70 cents a pound in cotton. I think cotton above 65 cents is a good scale down buy. Looking to take profits around the 80-cent level. And if anyone's interested, frozen concentrated orange juice, well, that's traded in a range this year from $1.29 to $2.35 a pound. And quite frankly, that is an illiquid commodity that I would stay away from. Although here, it's a better buy than a sale, in my opinion.
Gotcha. Wow, so much knowledge. And we can't stop here. We got to go to oil, because
we go to oil and natural gas. I want to cover oil and natural gas quickly.
Yeah.
Now, oil's interesting. Oil, the sweet spot for oil, in my opinion, is $50 a barrel, because it's a price that makes consumers and producers happy or miserable alike. All right? It's half the price it was in June 2014 when the price got up to $107 a barrel. So consumers can be comfortable with a $50 a barrel price. On the producer side, in February 2016, we got down to $26.05 per barrel. We are, at $50, it's about double the price of that it was there. So as I said, it's a sweet spot for WTI sweet crude. It's a price that makes consumers and producers alike happy. Right now, we're seeing some selling pressure in crude oil because of Hurricane Harvey. Not a surprise, because the feedstock for refineries, a lot of refineries around that Texas, Louisiana coast, they're not going to be taking that feedstock. But we are seeing big moves higher. While oil's going down, we're seeing gasoline prices move higher. Very interesting. We're seeing heating oil prices move higher, which means that crack spreads or processing spreads are moving up. So I'll put up a chart of the gasoline crack spread, and you can see here, wild move up here to $20 a barrel. I look at crack spreads. To me, they're two things. They're a real-time indicator for profitability of refining companies, because the higher the crack spread, the more money they make, the lower, the less. They are also a demand indicator for crude oil itself. If the crack spread goes up, it means that more people are demanding crude oil products, and refineries need to make more, and that means they need more of the raw crude oil. So I think that they will be supportive of the price of crude oil. Another interesting spread, if I can find it here, let me see if I get it. There it is. This is the Brent versus WTI spread, and we can see we've had a big move. The Brent premium has gone up dramatically over recent weeks against WTI. And there's two reasons for that, David. The first reason is that shale producers in the United States are producing a lot more shale oil today. That's WTI oil, which is depressing it under Brent. Second of all, OPEC cuts have cut the production of Brent oil, because 2/3 of the world's oil uses Brent as a benchmark pricing mechanism. All the Middle Eastern crude is priced off Brent. And the other thing that goes through all industrial commodities here is China has been buying industrial commodities, and when they buy crude, they tend to buy Brent, and that is exacerbating the spread. The Brent spread plus the processing spreads, the crack spreads, lead me to believe that crude oil, even though it's coming down here, it's under $47 a barrel, it's a lot closer to a low than a high, and I believe it'll go back to $50 and maybe even overextend on the upside. That's what I'm seeing in crude. Let me just quickly talk about natural gas here, because this is a market that I really think is interesting. Natural gas is It's been for many years a seasonal commodity. It tends to rally in the winter when it's cold. It tends to dip in the summer. In the summer is injection season as we fill up inventories. The winter is withdrawal season as we use the inventories for home heating. However, there's been some dramatic changes in the natural gas market. You have huge finds of natural gas in the Marcellus and Utica shale regions of the United States, which depressed prices and sent them down to the lowest price since the late 90s in March 2016, when nearby natural gas futures traded down to $1.6110 per million BTUs. Since then, the price has been going up, and it's been going up because there's two new demand verticals in natural gas. First, you have a switch from coal-fired power generators, electricity generators, to natural gas. That's a new demand vehicle that's been increasing. And the second is because of LNG. You know, new technology, we've been able to liquefy natural gas, put it on vessels, ship it abroad to areas of the world where it's more expensive than it is here. So that is curtailing the amount of production in the United States that's used for domestic needs. So I believe that, and we've seen this in the EIA numbers that come out each Thursday morning at 10:30 a.m., and we've seen that natural gas this year is trickling in rather than really flowing into storage. We are likely to go into storage into the winter season this year with less than 4 trillion cubic feet, and that'll be the first time in 3 years we go in at that level. If it's a cold winter, I could see natural gas going to $4, $5, or even $6 per million BTUs. And now the price is under $3. So I think that's an opportunity here where the downside is pretty limited, the upside is pretty explosive, and the risk reward favors long positions, but on price dips in natural gas.
Amazing. You're so nimble with those charts. I've never seen anybody go from one chart to
That's
another.
Not me. It's CQG. I love the product.
Oh, well, no, but it's you also. You know. Obviously, you know your charts, and I like the way you combine the charts with the fundamentals. You're not a chartist per se. You're not a fundamentals guy. You're both. You're a big
Right.
picture
I like to call it technomentals. You know,
Yeah.
from my perspective, I learned this commodities business from the supply and demand side. The bottom line is markets go up when there's more buyers than sellers, and they go down when there's more sellers than buyers. And supply and demand is really everything. It's the core, and it's the driving force for the path of least resistance. However, you have to respect the herd mentality, and you have to respect the funds, the hedge funds, the mutual funds that go in and out of these commodities, which can tend to be the most volatile assets of all. So, you know, you have to respect that, and you have to pick your entry and exit points based on what they're doing. Sometimes you want to go with them, sometimes you want to go against them. It all depends on the fundamentals.
If you want to tap into Mr. Hecht's knowledge, one thing you want to do is go to Amazon. I'm going to put this link in the description of the video for sure. How to Make Money with Commodities. What a perfect title by Andrew T. Hecht with Mark S. Smith. That is available on Amazon.com. Link in the description. I believe that's the only one that I've found that you've authored. Am I correct?
That's the only book. That's the only book I've written. I actually have another one, but I haven't had it published yet. It's kind of more historical, anecdotal about some of my experiences trading some big positions, particularly in silver. Maybe one day I'll have the time to get it out there, but right now that's the only one I have. But anyone who's interested in hearing more, tune into my show, which is on Tuesdays and Thursdays on TFNN.com from 5 to 6 Eastern Time. Or, you know, check out my articles on Seeking Alpha. I generally write between 8 and 10 pieces a week, generally focused on one commodity. Each piece is on one commodity or one sector. I even write on the stock market and the foreign currency markets. And, you know, you can follow me very easily there. I've probably written in the last 2 years 600 or 700 articles for Seeking Alpha.
Wow, you're a busy man. I don't know how you do it. And finally, social media. If people want to follow you, how can they do that?
I'm on Twitter at technomentals.com. My blog is dynamiccommodities.com. But really the best way to find me is through Seeking Alpha. Yeah. I have a weekly service there where my weekly report is really comprehensive, David. Right. It's about 10,000 words, about 40 pages or so. I cover all of the 30 commodities that trade in the futures market. I give an up, down, or sideways call for the coming week, and I do make specific recommendations, generally in ETF or ETN products. You can follow me on Seeking Alpha. That's really the best place. That's where I put most of I use that as my main portal. And you can email me through Seeking Alpha, and I try to answer all emails within 24 hours.
Yeah, you're very accessible. I know that from personal experience, which I think is fantastic. You know, when people have questions about commodities, there's so many ways to reach you. They should tune in Tuesdays and Thursdays from 5 to 6 p.m. Eastern Time to TFNN.com. Check out the Commodities Hour with Mr. Hecht. You know, reach him on Seeking Alpha. Check him on Twitter, dynamiccommodities.com. If you really want to reach him, you can. There's no excuse.
Yeah, absolutely. And watch these commodity markets, because you have to remember that commodities are really the basis for a lot of markets. They impact the stock market. They impact the bond market, the currency markets. And a lot of people who invest in stock, if you give me a stock, I could tell you how commodities affect that stock. Because whether it's if you're buying, let's say Amazon, they do a tremendous amount of moving their goods around the country. So they're massive consumers of energy in terms of their logistics. So any company that you have in your portfolio in some way uses commodities. So it behooves investors to really have an understanding and at least follow developments in the commodities market so they don't get blindsided in their investment portfolios.
And that's exactly how you help people to navigate this complex world of commodities. You make it understandable and you make it profitable, which is what this is all about. Mr. Andrew Hecht has been my guest today. Thank you, sir, for coming on Looking at the Markets, and I hope you'll join us again sometime soon.
Absolutely. Thanks so much, David, for having me. I really appreciate it.
It's different now.